when we talk about silver, as far as I'm concerned, it's up 43% this year. And when you have a Fed that is going to come in and lower rates into an environment where asset prices are at or near all-time highs in the stock market, in gold, when silver's on this run, I would expect to see this rocket fuel charged. When the market was from 2007 to 2011, when they cut rates, gold went up 118%. From 2020 to 21, when they cut rates, gold went up 35%. So I think not only will you see that in silver, you will see it certainly in gold. But going back to silver for a moment, 52 million ounces of silver were already delivered on COMEX this month, with 3 weeks left to go to push it even higher, just over 2 weeks. There's no question that something bigger is happening. I mean, there is no question about that, right? And
silver just ripped past $43 an ounce, its biggest surge in years. And Andy Schectman warns this could be the start of a historic breakout. COMEX deliveries are exploding, London's vaults are running dry, and lease rates are at 6%, the highest in decades. This isn't a drill, this is happening right now, and if you miss it, you might be chasing silver at $90 or even $100 before long. Before we break this down, hit that subscribe button and turn on notifications so you never miss critical updates like this. Our channel brings you the truth about gold, silver, and the global economy, the kind of insight mainstream media won't give you.
A lot of it focuses on the LBMA. I'm going to try and make this part a little bit easier to understand. It's somewhat complicated for people who don't understand the lingo. I'll try to make it as easy as possible. First of all, when you look at gold, speculators are returning into the gold market. We can see that on COMEX with open interest rising again. That means open interest is the amount of interest, and people are interested in buying the metal. Open interest is rising, and prices are breaking out of this consolidation range. We see it bust out again. That's the normal link between purchasing and higher prices, right? But in silver, what we're seeing is something different. The rally is being driven not by speculators, but what seems to me by some form of a short squeeze, because you have record high lease rates in London to lease the gold. That would be the same thing if you wanted to short a stock. There's a cost to borrow the stock from an entity that then allows you to short it. A stock is something, if you short something or naked short something you don't have, you have to borrow the stock first and then short it. Same thing here. You have record high lease rates with silver in London, anywhere between 5 and 6.5%. Normally, those lease rates are somewhere around 1% or a fraction of a percent. Even in times of stress, they barely get above 1%. Right now, they're between 5.5% and 6%. I'll talk more about that in a minute. But you also have falling open interest, meaning the demand by the speculators is falling with heavy delivery demand. So far, 58 million ounces have been delivered since late August. Almost 11,000 tons have been delivered year to date. This points to shrinking physical liquidity and mounting pressure on the market. In other words, the short positions are struggling to get the metal to cover their positions. As the lease rates go higher, the people who own it are like, nah, we're not going to give it away 5 or 6%, which is way higher than it ever is. With everyone standing for delivery, this is a problem. And when we talk about what's happening on the LBMA, recent data shows about 600 million ounces of silver are traded every day in London. There's about between 1 and 2 billion ounces of paper claims on meaning they could stand for delivery, between 1 and 2 billion ounces, yet the official available free float is only 140 million ounces. So in other words, if there's 1 to 2 billion ounces of claims against 140 million ounces available to be delivered, and a lot of that is already locked up and not truly liquid, what could possibly go wrong? In other words, London has virtually no free silver to meet these rising investor demands or to back the billions of ounces in outstanding contracts. This is getting interesting. And at the same time, you see the COMEX flush with metal. All of that metal, I remember I screaming, this is not about tariffs. And all of that metal that's come back to the United States has put I believe the U.S. banks on solid footing. Normally, when the U.S. bank shorts COMEX, they go long delivery contract in London to offset. Well, they've brought all that metal back, and you could argue to put their book in order. These European banks are facing an existential threat. With lease rates and prices spiking, the risk of a delivery default in London is rising. And, this is the chain reaction that you would talk about. Silver, its status as a Giffen good. I don't know if you know what a Giffen good is. Then again, a Giffen good is something that as prices rise, demand increases. Most assets or investables are the opposite of that. As the price spikes, demand falls. With this, as price rises, demand increases, making shortages even worse. As the industrials will say, man, the price is rising, we got to buy more, we got to get it, we got to secure it. The hedge funds and the traders say the price is rising, let's jump on, let's get them on board on this. And its status as a Giffen good makes the potential shortfall even worse. Now, when we talk about silver, as far as I'm concerned, it's up 43% this year. And when you have a Fed that is going to come in and lower rates into an environment where asset prices are at or near all-time highs in the stock market, in gold, when silver's on this run, I would expect to see this rocket fuel charged. When the market was from 2007 to 2011, when they cut rates, gold went up 118%. From 2020 to 21, when they cut rates, gold went up 35%. So I think not only will you see that in silver, you will see it certainly in gold. But going back to silver for a moment, 52 million ounces of silver were already delivered on COMEX this month, with 3 weeks left to go to push it even higher, just over 2 weeks. And as I mentioned, those lease rates at as high as 6.4%, they never get above 1 to 2%. And if only briefly when they do in times of stress, this is signaling that the bullion banks are trapped by their own over-leveraged promissory notes, the European bullion banks in particular. I think that's something that needs to be focused on. At the same time, you have silver added to the strategic minerals list by the U.S. government. This means that big buyers are entering the market, including the U.S. government. Companies like Tesla and others will stockpile silver at the same time. And so London's deliverable silver supply is vanishing. Its industrial needs and its investor demands are colliding between the industrials like Tesla and the investors. This is Giffen's good at work. I don't know. I'm looking for a severe shortage. Not to mention, you have a 45-year cup and handle pattern on silver, which is one of the most powerful technical setups you can find in markets, period. And on such a long time frame, it carries huge implications. It portrays 45 years of suppressed energy ready to be released, kind of like a coiled spring. And I think that the structural and monetary pressure, once unleashed, the move is violent. The way that it typically works is that a cup and handle is a continuation pattern. The cup is the long base. In silver's case, from the early 1980s through the decades of the consolidation. The handle is the pullback, the tightening range, like 2011.
Let's unpack exactly why Andy Schectman is sounding the alarm, and why this moment feels different from any other silver rally in recent history. First, look at the macro setup. The Federal Reserve is widely expected to cut rates soon, just like it did between 2007 and 2011, when gold exploded 118% higher, and again in 2020 to 21, when gold climbed 35% in a single year. This time, silver is already up 43% year-to-date, meaning the stage is set for a potentially even bigger move. But Andy's main point is that this isn't just a speculative run. This is a physical squeeze playing out in real time. COMEX has already delivered more than 12,000 silver contracts this month, with 2 weeks still left to go. Year to date, deliveries are at some of the highest levels on record, which means investors aren't just rolling their contracts, they're taking the metal. The real pressure is building in London, where roughly 600 million ounces of silver trade every day, yet only 140 to 155 million ounces are truly available for delivery, a dangerously thin cushion. Against that sits 1 to 2 billion ounces of paper claims. If even a fraction of those claimants demand physical silver, London could face a delivery default. Meanwhile, lease rates for silver have exploded to 5 to 6.5%, levels almost never seen before. Normally, these rates stay under 1%, even during times of stress. High lease rates mean short sellers are scrambling to find physical metal, and paying a steep premium to do so. This is why Andy describes the current move as a short squeeze, not a normal bull market. And here's what makes silver unique. It behaves like a Giffen good, meaning rising prices actually bring in more demand instead of less. Industrial users like Tesla, solar manufacturers, and even the U.S. government, which recently added silver to its official strategic minerals list, are stockpiling aggressively. Investors see prices climbing and rush in to front-run higher levels, creating a feedback loop that tightens supply even more. On the technical side, silver is pressing against one of the most powerful chart patterns in history, a 45-year cup and handle formation with the rim at $50 per ounce, the level reached in 1980 and 2011. Breakout above that level could unleash decades of pent-up energy, with classic charting projecting an initial target between $90 to $100 per ounce. Combine that with this supply squeeze, and triple-digit silver is no longer just a fantasy. It's a very real possibility. Finally, Andy points out the behavioral split between retail and institutional money. Small investors are still all in on stocks, with record margin debt and speculative options exposure, while insiders are quietly exiting equities at a 7-to-1 ratio and standing for massive gold and silver deliveries. In Andy's view, the smart money is preparing for a reset while the public remains distracted by the stock market and AI hype cycle.
So once prices break above the rim, that $50 price that we saw in 1980 and 2011, the price can go parabolic. The classic charting rules, the upside target, you take the depth of the cup added to the breakout point. So the depth of the cup, the rim is at 50, the bottom is just below $4 in the 1990s. That's about a $46 or $47 spread between the top and the bottom. So in theory, the breakout above 50 with no resistance above it, add $46, $47, the difference from the top to the bottom of the cup, you're at a $100 initial target, between $90 and $100. And when you throw in the shortage, when you throw in the demand by the big money, when you throw in the demand by the BRICS countries, etc., I don't know, triple-digit silver isn't really so out of control. It's not out of line as far as I'm concerned. One last point I'd like to make about gold and silver. You know, it's interesting to me that, and in particular gold, because silver has yet to catch the same fire that silver has, that gold has caught. And, you know, we look back over the last half a year or so, and the S&P 500 in the last 5 months or so is up almost 1,700 points. That's one of the strongest rallies in history, right? Gold is up about almost 40%, about 39%, when compared to the S&P's return over the last 5 months, which is one of the strongest returns ever. Gold is up since 2023. Gold's up 100%. The S&P is 67%. That's great. But just over the last 6 months, where everyone's focusing on NVIDIA and stuff, where it's up as big as it is, 1,650 points, gold's run is up 4 times the S&P's return just in the last 6 months. It's up 37% versus 9%. And so even amongst this AI boom, the biggest tech story since the internet, equities are still trailing gold, and yet nobody talks about it. So I remember when gold finally broke through $400. I couldn't believe it. It finally broke through $400 all those years ago. And if you would have told me that we are sitting at futures almost at $3,700 right now, and the media and no one understands it, to me, it's absolutely insanity. The big money understands it. And this is what I was talking about recently, where you have the largest exposure to stocks in the history of the stock market by mom and pa investor. You have the largest ever margin exposure, which is $1 trillion, and you have the largest exposure to options. So you have the public all in on stocks, all in on margin, and all in on speculation with options. At the same time, the investor, the big money, the insiders are leaving at a 7-to-1 clip, leaving the equity market and going where? I don't know. Maybe they're going to gold, as the biggest money in the United States is standing for billions and billions and billions and billions and billions, and I can keep on going every single month. Every single month, we are seeing huge deliveries into COMEX. And why does nobody talk about it? So let's just paint the backdrop for a minute and talk about our wonderful mainstream media that lacks all journalistic integrity, period. The greatest boom ever in the S&P because of the AI revolution is trailing the price of gold and silver. The insiders are dumping equities and running to, we don't know, as the public is all in the stock market, not just all in, greater than at any time in history. In fact, not only are they in greater than any time in history, the valuation is at the highest point in history, greater than the 1929 crash, greater than the '08 crash, greater than the dot-com crash. And they're not just all in, they're all in on leverage and margin. And so with all of this metal coming into COMEX, both gold and silver, record amounts, net importers, record amounts, and the public not owning any, and it outperforming the S&P, where the hell is Fox News? Where the hell is this idiot Jim Cramer? Where the hell are all the people that are supposedly looking out for you and I?
Here's Andy's message to you. This is not a drill. The signals are flashing red. Lease rates spiking. COMEX inventories draining. LBMA free float vanishing. If London faces a delivery failure, the entire paper-silver system could reprice overnight. If you've been waiting to protect yourself, waiting for the perfect entry, Andy would say that waiting much longer might leave you chasing a runaway price. This is the moment to get educated, get positioned, and make sure you're not left on the wrong side of history. If this breakdown helped you understand what's happening, hit the like button, share this with fellow investors, and subscribe for more critical updates on gold, silver, and the global economy. Question for you. Do you think silver can smash through the $50 ceiling before the end of this year? Or will the bullion banks manage to hold the line a little longer? Let me know what you think in the comments.